Deflation. The initial economic challenge of COVID-19 was disinflation, a situation of significantly lower inflation rates than the central bank's 2% target, often leading to deflationary concerns. The U.S. tracks inflation primarily through the Personal Consumption Expenditures (PCE) inflation rate and the Consumer Price Index (CPI), each offering different insights into price changes. Core inflation, which excludes volatile food and energy prices, is the Federal Reserve's focus for its 2% target. As the pandemic progressed, both the core and overall inflation rates, including volatile items, decreased notably, with April 2020 marking a period of negative oil prices and further diminishing inflation rates. Lower inflation might initially seem advantageous for consumers due to cheaper goods and services, but sustained deflation can have detrimental effects. It increases the real value of debts, discourages consumer spending due to expectations of further price drops, and can trigger a vicious cycle of reduced demand, employment, and economic activity. Businesses, while potentially benefiting from lower raw material costs, often face the downward rigidity of wages, leading to reduced profits and possible job cuts. The Great Depression exemplifies the extreme consequences of deflation, where a significant drop in prices led to widespread unemployment, bank failures, and a substantial economic downturn. The COVID-19 crisis, therefore, presented significant deflationary pressures, necessitating careful economic management to avoid long-term detrimental effects. Disappeared inflation. Inflation has been notably absent in advanced economies for a considerable period, especially since the stagflation of the 1970s. This period of high inflation and economic stagnation led the U.S. to develop strategies against rising inflation, with the Federal Reserve often considering preemptive interest rate hikes at the slightest hint of inflation nearing the 2% target. However, since the 2008 financial crisis, inflation rates in the U.S. and other advanced economies like Europe and Japan have remained subdued, rarely exceeding 2%, even amidst large-scale quantitative easing. The disappearance of significant inflation has led to a flattening of the Phillips curve, which traditionally depicted an inverse relationship between unemployment and inflation. Despite a period of full employment and reduced interest rates before the COVID-19 outbreak, inflation remained low, contradicting standard economic expectations. This flattening can be attributed to factors like globalization, which led to cheaper imports and reduced production costs, the Amazon effect, and other technological advancements that kept consumer prices stable, and an aging population more sensitive to price changes and less inclined to consume. These developments have allowed central banks and governments more leeway in implementing monetary easing and fiscal stimulus without the immediate fear of triggering high inflation. Surge in savings rates. The COVID-19 crisis led to an unprecedented surge in U.S. personal savings rates, reaching a historical high of 33.8%, a sharp increase from the usual average of around 7%. This record-breaking savings rate was partly due to the restrictive nature of lockdowns, which limited spending opportunities, particularly in service industries. Additionally, financial aids like the CARES Act and special unemployment benefits increased household incomes, contributing to the rise in savings. While increased savings can seem positive, during a deflationary or disinflationary period, they can lead to reduced consumption, exacerbating the economic downturn. The government aims to boost consumption through household subsidies, but their effectiveness relies on funds being spent rather than saved. If banks are reluctant to lend, the economy may face a liquidity trap where, despite ample liquidity, consumption, production, and investment remain stagnant, negating the efforts of government and central bank interventions. This situation reflects the complexities in stimulating economic activity and managing deflation during a crisis like COVID-19. Japanification. The term Japanification refers to an economic condition characterized by persistent low growth, low inflation, and low interest rates, similar to what Japan has experienced since the 1990s. Amidst COVID-19, concerns arose that the U.S. might follow this path, influenced by prolonged liquidity traps and aging demographics. To counteract such stagnation, Japan adopted unconventional monetary policies like negative interest rates and aggressive fiscal spending, leading to a national debt ratio exceeding 250%. In April 2020, discussions in the U.S. revolved around adopting negative interest rates as a remedy for prolonged deflation, a move to incentivize banks to lend more by charging them for parking excess reserves. While some countries have implemented negative rates with mixed results, the U.S. Federal Reserve maintained its zero interest rate policy and did not venture into negative territory, emphasizing its commitment to current policies for combating deflation. Investors speculated on further easing measures, including the possibility of negative rates or yield curve control, YCC, where the central bank targets specific long-term rates. However, the Fed expressed skepticism about these strategies' costs and effectiveness. Despite the market's anticipation of negative rates or YCC, the Fed continued with its existing policy framework, navigating through the deflationary pressures and uncertain economic landscape brought on by the pandemic.